What I'd like to do today is to talk about the security analysis assignment. So we're going to get started on that. And as you can tell, maybe you can tell, it's kind of small print. RPM International Inc. is our company this semester. Anybody know RPM International? Most of you are from Cleveland, right? RPM International is right here. About a $10 billion company, too, by the way. So there's more than just Eaton, Progressive, KeyBank, and Sherwin-Williams, Goodyear, and so on. RPM is no slouch. But RPM is in a similar market to Sherwin-Williams, coatings, caulks, things like that. You've probably either seen, if you've ever been to Home Depot or Lowe's, or maybe even used some of the items that RPM International produces. I want to say it's DAP, D-A-P. You ever used DAP caulk? You ever used, I think they have Rust-Oleum too, is one of their brands. So we're talking, you know, you never heard the name. It's sort of like, you know, you've never used the product, but their product makes something better. You don't know RPM International, but you know some of their brands. I picked the company partly because, hey, it's here in Cleveland. Maybe some of you are even going to work for them. Maybe you get an interview with them and you say, oh yeah, we did a security analysis on RPM International. You may want to say, oh, it was a buy recommendation, definitely, regardless of what your actual recommendation was. But you get the idea. You'll know a heck of a lot about this company by the time the semester is over. They pay a dividend. That's another one of the criteria that I like to have in there, is that they're a dividend payer. It's not necessary, right? We've got the residual income model, so we can value without a dividend. And we've got other valuation techniques that we're going to be using. But you know, it's nice to have that dividend there as well. They're not quite as small a company, but you know, 10 billion market cap is definitely not big. They've got some institutional ownership. Anything over about $1 billion typically has institutions interested. Less than $1 billion, not so much. And generally, it looks like an interesting company to look at. It's also relatively a single line business. So they do coatings and caulks and things of that nature, both on the retail side as well as on the B2B side. But you know, not too many different, the flavors are all very similar. So that makes the analysis a bit easier as well, since this is the first time through for everybody. So RPM International, go to the assignment itself. So this will be uploaded as a PDF onto Canvas. I've got some ancillary documents there available to you too, and I'll show you some of those as we go through this. But this document is kind of the key document, and it will tell you what you need to do and what's due on a particular date. So, and actually, I kind of like this quote because this is quite apt for what we're doing. Don't play what's there, play what's not there. Miles Davis, jazz trumpeter and musician. Play what's not there. What does he mean by that? Everybody knows Miles Davis, right? If you don't, you should. Fantastic jazz musician. What's he mean by don't play? I know a number of you must be musicians, right? Or at least dabble around, play guitar, trumpet, drums, right? Piano. By playing now, what's not there? All right, I know things were very quiet when I walked in the room. Is this? Yeah.
Does it mean like pave your own way?
Yeah, I think you could look at it that way. Yeah, absolutely. Not only that, but you know, music tells you. You look at a sheet of music, and again, I don't know how many of you read music. I keep relearning reading music. I'm taking guitar lessons right now for blues, and some of the things I'd forgotten. But there's little notes about how you should play this pianissimo, very quietly. But there's also a little bit of putting some flair into it, putting some emotions into it that changes from just a very sterile playing of a piece to something that is going to move people when they hear it. And that's where I also take that away from what this quote is. Maybe he meant a little of both of that, but it's working on the things that you don't necessarily see on the surface, and it's up to you as the analyst to tell the reader, what is it about this company, RPM International, that I need to know about that isn't obvious just by going into Bloomberg? So it's the what's not there that you're going to illuminate for us as an analyst. So that's why the quote. So the basics, what you ultimately hand in, which I believe is what they say, December 7th. So the final deliverable, this is the third deliverable, is a written document. It should have a title page with your names, the teammates' names. It should have a table of contents. The easier that I can find things, and the more likely you're going to get points for that. Should have an executive summary, and I'll show you an example of that in just a second. It's not the executive summary that you might think it is. And then all other written documentation that you have gathered as part of this exercise. For the most part, if it's a link to a PDF file or to the financials, the 10K, the 10Q, that's fine. I don't need the entire document. Most of you aren't going to download the entire document. You'll probably just have a link so that you can go read it online, right? So you might have 2 or 3 pages of links that fill in all the blanks. I've got details as far as what you're required to get, but that's the minimum, right? You can always get more. As well as spreadsheets that you come up with, a couple of spreadsheets that you're going to be working with. One to graph the ratios, and another to do the pro forma and the discounted cash flow analysis. By the way, while I'm talking about that sort of thing, I'm going to disallow the use of Google Docs or Google Sheets, right? Some rationale for that is probably appropriate. One is that I find that oftentimes Google Docs or Google Sheets, the permissions are a pain in the neck. And if I can't get in there and check your spreadsheets, I can't tell whether you did them right, and I can't give you the grade. So that's one of the rationale for it. The other is that Google Sheets in particular doesn't have all the functions that you have available to you in Excel. I know that some businesses are shifting to a Google Doc, Google Sheets framework, but I would bet quite a bit of money that the majority are still using Word and Excel. So with that, having said that, you're going to do all of this in Word and or Excel, and upload those files to Canvas in the assignment when I post it for you. So this is a top-down security analysis. You're going to be starting at the economic perspective. What's happening in the economy? What do we think is going to be happening in the future in the economy? Work our way down to the sector and industry. What's happening now? What's going to be happening? What's our forecast? Then work ourselves down to the company. How is it looking right now? What do we expect in the future? What about its competitors? What about customers, suppliers, employees? A lot of qualitative elements, community even, ESG, things of that nature. Bundle that all together and boil it down to either 1 or 2 words. Strong buy, hold, sell, strong sell. 5 choices. You're not going to be limited, like most analysts are, to the top 3, right? Usually, if you look at analyst reports, you rarely see sell. And I would be willing to bet out of, if you looked at a 500 analyst reports, you probably wouldn't ever see a strong sell. So they've truncated the choices. Why? Now, if I give a company a strong sell and I work for investment bank ABC, that company is not likely to send other business my way as the investment banker. And even though there is a paper wall between the analyst side and the rest of the bank, you know, the analysts aren't stupid. The other side of the bank doesn't have to tell me, don't give this company a strong sell because we're trying to curry favor with them. That seems pretty obvious. So there's always a bias upward. You guys don't have that bias. You can put a strong sell out there if you think it's a strong sell. By the way, I should also mention that when I grade this assignment, I don't grade it based upon whether you got the answer I got or whether you got the answer that's the majority answer. I grade it based upon process. And we'll look at that grade sheet towards the end of the class period. I think we'll have time to get to that. So I've laid out how I'm grading it. And a lot of it is checkbox, right? Some of it is qualitative, some of it is how well you put the report together, how neat it is, and the things that you say in the quality the written portions of the report. But a large part of it is also just, yep, I got the 10K. Yep, I got the 10Q. Yes, I got the media articles. Yes, I got the forecast, etc. Okay, so here are the key due dates. First due date is November 1. That's deliverable 1. And I'll color coded this on the subsequent pages, so I'll show you the detail. The next page is what's due on November 1. You just go through that list of items and you do all of those things, turn it in, boom, you get full credit for that. The big deliverable is November 22. That's where the bulk of the work that you're going to be doing comes in between the 1st and the 22nd. So you're going to be doing the pro forma financial statements. You're going to be doing the evaluations. You're going to be estimating growth rates, estimating Ks. And trust me, estimating growth rates and Ks, what you saw in the homework, that's child's play. We're going to use that as a baseline. But in this project, that's just a starting point. I'll talk again, I've got more detail describing why I say it's just a starting point and why it's important that we dig a little bit deeper. December 7th is the final deliverable. And that's the entire enchilada, the written analysis, the summary, the title page, table of contents, all of the material that you put together, all of the qualitative and quantitative material, spreadsheets and so forth. So everything gets packaged together. Here's an example, rough example of an executive summary. You see this often as the first page of any analyst report. In fact, this one, Darden Restaurants, I've got the rest of the pages in Canvas for you to look at, just as a benchmark for this is what we're shooting for. I don't expect anybody to get here. I do expect you to get here. This is the first time through. You're going to find that this is a fairly complex process. And you probably won't realize how complex until you start doing it. So for example, you know how when we were calculating K, we needed a beta, we needed a market risk premium, and we needed a risk-free rate, right? And we were given all of those things. All we had to do is plug and chug and out pops K, piece of cake. Not so here in the real world. Yes, you can get beta from Bloomberg. Yes, you can get it from Zacks. Yes, you can get it from Yahoo Finance. But you're probably going to get different numbers from each of those sources. And there may be significant variance between those beta estimates. So who's right? You're right, because you're going to calculate your own beta using your own assumptions. So you're going to go to Yahoo Finance or Bloomberg, download the price series, convert that to a return series, and you're going to regress the stock's return on the market's return, and you're going to get a beta coefficient. Again, that sounds pretty simple, doable. What sort of frequency am I going to use? I can get daily, weekly, quarterly, monthly, annual prices out of either Yahoo Finance or Bloomberg. So I can do either daily, weekly, monthly, quarterly, or annual returns. And I could get a year's worth of data, or I could get 10 years worth of data, or even 15 or 20 years worth of data. But what is the appropriate amount of data to use? That's up to you as the analyst. Guidance from me would be, don't go daily. Daily is too frequent. Daily is going to give you a large N. You can get 252 prices in a year, so you could run it on a single year, but daily price fluctuations are inherently noisy. So you're probably not going to get a very strong beta estimate, even though you've got a large N. So most of us tend towards weekly, monthly, or quarterly. Annual, you get too few observations, right? You got to go back at least 30 years, which is absurd. So weekly, monthly, quarterly, and then how far back am I going to go? Well, my answer to that question is go as far back as you think the company is the same company as it is today. And again, you've got to do some digging into the company, understand what the company is, where it's changed, has it done some big mergers, and is it the same as it was 5 years ago? If so, go back 5 years. Oh, but wait. 5 years doesn't include a market trough, doesn't include an entire business cycle. So actually, my preference would be go back as far as I can. Go back past the financial crisis, because that's our most recent business cycle. But was the company the same company? So you get the idea, right? There are problems here, and it's up to you as the analyst to solve these things. This is no longer a well-defined homework problem where you're given everything. This is now the real world, right? So you've got the theory, you've got the grounding from the first half of the class and looking at in particular chapter 6 on valuation. But now we're going to go to that next level. All right. Questions on either that or just the general framework, due dates? The last element is December 8th. That's the last day of class. We're going to debate this recommendation that you have. And you're going to defend your recommendation against everybody else's. Inevitably, recommendations are going to vary. Somebody might be a buy, somebody else might be a hold. Maybe somebody else is a strong buy. Or maybe we've got a sell in there too. So it's up to you to clarify, why is it that yours is a sell and somebody else's is a hold or a buy? And that's going to be an in-class thing that we don't have a ton of time for this, but you'll be able to hopefully make your most salient points. All right. So here's the first deliverable. This is November 1. Start with getting 5 years of electronic financial statement data. Very, 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 very strong recommendation. While you can get it from other sources, go to Bloomberg. We have a Bloomberg terminal. It's not that hard. The data is consolidated the same way from company to company to company. So, by the way, not only are you going to need RPM International, you're going to need data for the comps as well, at least in terms of ratios. And you probably should download the financials too for your comps, just so you know what's going on, or at least a 10K, most recent 10K. So go to Bloomberg and get that. It's nicely formatted. You do have to do a little cleanup, but it's not very bad to do the cleanup. So you get that. That's going to provide the framework for the next deliverable, which is your pro forma financial statements. So the point of getting this 5 years is so that you can see how various accounts change over time. And we're going to use that percent of sales method that they described in chapter 19. You need to get a copy of the 10K and the 10Q. And I'd recommend going back in time too. Get the year before, a couple of years before that, at least of the 10K. 10Q is just going to give you the most recent update. I forgot to look at when their close of fiscal year is. Most companies close their fiscal year December 31. I don't know whether IPM International does or does not. If it does, then you just need the most recent 10K. If it doesn't, then you need the most recent 10K plus the 10Q update. And again, you can get that from multiple sources. The company website, rpminternational.com. Usually they have the pretty version of it that's got the graphics and the nice formatting, the thing that they actually print up and send out to their shareholders. Or you can go to EDGAR, sec.gov, and click through to the EDGAR database, electronic data gathering and retrieval system that the SEC maintains, where all filings are required to be. And you can pull down a PDF, very sterile version of it. I like to get the graphic one, with gives you some sense of what the company, how it tries to present itself. So grab that one. Grab the 10Q from whichever source. By the way, when you're looking up company information on a company website, typically it's either at the bottom, in the small mice type of other links, and you're looking for investor relations is what you're probably going to find it listed as. Obviously, you want to look at the rest of the site too, just to get a sense of how does the company present itself through the internet. You need some industry-related data, particular ratios and key statistics. And this relates to not only the industry as a whole, but you're going to come up with a group of minimum of 4 comparables. Or think of them as peer companies, companies that are most likely competing for the same dollars that RPM International is competing for. Actually, Sherwin-Williams, so happens, is likely a potential comparable. Of course, the problem with Sherwin-Williams, it's about 3 times bigger market cap, much broader appeal, much better known name, more brand names that are well known in Sherwin-Williams. So it's up to you. I'm not suggesting you should or shouldn't use Sherwin-Williams, but one of the things you're going to want to match on is market cap. It's usually not appropriate to compare a very large cap company with a mid cap or a small cap company. Again, back to the housing example. I want to sell a 2,000 square foot house. I'm not going to use a 5,000 square foot house as a comp, or a 1,000 square foot house as a comp. I want to get something, within 10%. So keep that in mind as you're looking for comps. So you're going to get that data. We'll talk more about the comps in just a minute down here. You need an industry outlook. As an analyst, you're probably working in a particular industry, maybe even sub-industry, and you would probably generate that on your own if you're out in the real world. Since we're not in the specialty chemical business already, we're going to use the forecast from Bloomberg. Bloomberg has a really great forecast. I've got one that, since we just recently did Sherwin-Williams, I have the most recent forecast from Bloomberg. It's dated, I think it's like August of this year. That may be the most recent one that is available. I'll go look. I'll upload it to Canvas for you so you don't have to dig it up. But it is available through Bloomberg. So we'll use that as a forecast. But you need to have that. You need to have read it. By the way, all of this stuff, the 10K, there's a lot of reading to be done, especially things like management discussion. You want to read that management discussion in detail to see what's management thinking. How are they valuing this company? How are they improving this company? And that will help guide you in terms of your final recommendation. You need economic data. Again, Bloomberg. Normally, you're working in the real world. You've got an economist on staff, and that macroeconomist is going to say, here's my current update on where I think the economy is going. Use it as you see fit. in our situation, we're going to take an off-the-shelf report generated by Bloomberg. You need some current data that's relevant to either the company or the industry. And that can come out of the Wall Street Journal, out of Barron's, out of any of the business press, out of any of the popular press. The more of that, the merrier. And remember, you're looking for what's not there, right? You're looking for the things that other people overlooked. That's how we gain some value, right? That's how we keep our jobs. Forgive me if I've used this example in the past, but this example, I think, really proves what a good analyst should be doing. Back prior to most of your births, given that we're in 2021 right now, back in the late 90s, we ran into a little problem that when the year turned to 2000, all of a sudden there was serious concern, very serious concern, that the computer systems around the globe would come to a screeching halt. And the reason is that back in the 40s and 50s and 60s, when computers were first being developed, memory was just extraordinarily expensive. So instead of coding a year with 4 digits, as in 1940 or 2002, we coded it with 2 digits. So we just coded 40 was 1940, 50 was 1950, 83 was 1983. Problem is that when we turn to the year 2000, it goes back to 00. And I've got a mortgage that was started in 1990, so it's coded 90. And all of a sudden, I'm in 00. I don't know how to calculate your mortgage payment. I don't know when your mortgage is due, right? So therein lies a major problem. So these companies who knew where that code was buried amongst the millions of lines of code, where there might be a 2-digit year buried somewhere in that code. So we had to pour through code, find that, and try to prepare for this change to the year 2000. So this was called, obviously, the Y2K problem. Companies spent millions and millions of dollars preparing for this so that their systems would not crash and that the lights would stay on. So IBM, which was at that time much more prominent than it is today, was just selling services and computers and everything they sold like crazy. Their earnings were through the roof in the late 90s. All of the analysts, save one, had great optimistic forecasts for the next 3, 4, 5 years for IBM. Oh yeah, earnings are going to be fantastic. Who were they talking to? They were talking to IBM execs. There was one person, one analyst, who said, it just doesn't seem right to me. So that analyst went out and started calling IBM customers. And IBM's customers said to them, to the person, when he asked the question, how much are you expecting to spend in 2000, 2001, 2002? They said, as little as possible, because we blew our budget for the next 2 or 3 years on preparing for this crazy Y2K thing. So our spending is going to plummet after if hopefully we survive the Y2K. We won't spend another dime with IBM. And he kept hearing this over and over and over and over. And so he put a sell recommendation on IBM. Everybody else was buy or strong buy. Here's this one outlier. He saw what wasn't there. It turned out, luckily for him, he was right. If he hadn't been right, he was out here, he was an outlier, he would have been eliminated, right? As in the, not quite as bad as in the Squid Game elimination term, but more like just lose your job and probably not find another one for a while in finance. But, he was very confident of his recommendation. He saw what wasn't there. It's up to you all to look for those things that nobody else has seen or not seen quite in the way you have seen it. All right, on to, selecting the comparables. This, I think, is a really important thing, because if you've got crappy comparables, you're going to probably have a pretty worthless analysis and recommendation. you want good comps. Several sources you can start with. Obviously, Bloomberg is going to give you comps. They're going to tell you, hey, this is the industry, and here are the other companies in that industry. Zacks will give you an opinion, and Yahoo Finance will give you an opinion. I want your opinions. I want you to think about this as an analyst and say, I know all of these folks give me an opinion, and there may be 10 or 12 or 15 companies that they suggest are the comps. I want to come up with 4 or 5. You can come up with 6 if you want, but 4 is a minimum. Come up with the 4 that you think are the most relevant comparables to RPM International. So that means you need to know something pretty detailed about RPM International, what their business is, who they're selling to, who their market is, and then you also need to know that same thing about the comparables. So this should take up a non-trivial amount of your time coming up with that list. Don't just pick the top 4 off of the list that Bloomberg gives. You can certainly start with those and look at them, but I wouldn't stop there. So you come up with those comps, you're going to need to get some data about them. We'll look at that in just a second. Okay. So you've got this spreadsheet with the financial statements and ratios. By the way, when you're in Bloomberg, and let's see, I don't know if you can see it here. Yeah, right up here. See that little tab, ratios? So it's really easy to get ratios. You don't have to go back to basics. This is one of the things I'm actually going to say, go ahead and use Bloomberg ratios, right? They do a good job. It's very transparent. You can click and see exactly how they compute each ratio. And the nice thing is that they compute each ratio the same way for all the companies that are in their database. So use that to your advantage. So instead of having to get the financials and create ratios yourselves, you can download this ratio spreadsheet from Bloomberg, and then it becomes easy peasy. So you've got ratios, you've got the 5 categories that you need to get, and that comes out of this additional notes. And that's going to be part of on the resources on Canvas for you. Show you that. I haven't published this yet for you, but I will do so shortly. See if I can make this work any faster than it does. Are you all as frustrated with these passcodes and this Duo stuff as I am? It's nuts. We're letting IT drive the ship. And IT isn't very good at driving the ship. So in modules, when I publish this, you will see another little category called Security Analysis Project. This one, I haven't replaced this. This was the old one for Sherwin-Williams, but this will be that document that we're looking at right now. Then, this additional security analysis notes. This is just a compilation of things that I've pulled out of other textbooks that aren't necessarily covered in as much detail as we find in our current text. But I thought would be helpful as you're going through a security analysis. So I start off with, here's some ideas to think about when you're looking at the economic and industry analysis. And we can go down here, sensitivity of business cycle. Now that's something we did have in the text, but there's some different ways of looking at it. Here's Peter Lynch's 6 categorizations. Then we get down to, now, many of you probably walked into this thinking, oh, this is a very qualitative type of thing. There's a lot of qualitative pieces to this, but there's also a fair amount of qualitative stuff, very subjective things that we need to look at and understand about our company. So we want to know more about what's its competitive position? You know, is it the leader of the industry? Is it kind of in the middle? Is it a laggard? Where does it fall? We want to know something about who manages the company. How long have they been there? What's their background before that company? How do we evaluate them? You know, think about age, experience, how effective is the company's strategic planning? What about board of directors even? The board of directors is kind of guiding the whole process. What if the captain and or if the CEO is the captain and, you know, the executive VPs are kind of on the bridge. It's the board of directors that are telling the ship where to go. Right, they're actually getting it there. So board of directors matters. Do we have active oversight? Do we have some sort of strategic planning group? How do we compensate executives? Do we have interlocking CEO and chairmanship of the board? Are we following best practices in governance? Think ESG, right? Environmental sustainability and governance. This is that governance piece. Is the board, do we have a lot of inside versus outside directors, or is it the other way? Is there diversity on the board? How big is the board? Even minutia like that. If I have a board, you know how many people are on the board at John Carroll? Somebody looked that up? Last time I looked, it was 42. What would you say, how effective do you think a board of 42 is in governing the institution? We're not quite 42 in this classroom, so add another 10 people. This would be the board. We have to come to an agreement. Any ideas? Anybody thought about a board effectiveness and size of the board?
I think it'd take a lot longer, more people, and the decisions probably wouldn't be as extreme.
Yeah, I agree. In fact, what typically happens is even worse than that, is that a small subgroup of the board actually drive the entire process. The other 35 or 37 just go along with it. Who don't have a lot going on there. I mean, we got 42 people, but there's a half a dozen people that are actually driving this institution. And actually half a dozen is a little bit small for an effective board. We've got to have diversity of opinions and hear other voices. So we need not only diversity of opinions, but we need diversity of ethnicity, we need diversity of gender. All of that stuff matters. So when we're talking about something as simple as how big is the board? Studies, people looking at this have done research, and for the most part, most effective board size is between 8 and 12. Most companies kind of follow that process. If some are too big, then hey, that could cause the company to be less effective. So when I say, you know, look at what's not there, you gotta look at all of this stuff. Here are some of the ratios. Here are the 5 groupings. So we've got liquidity, activity, that's efficiency basically, profitability, leverage and capitalization, and then coverage ratios. You're going to use most of these. Some of them may not be particularly applicable to RPM International. I mean, maybe they don't have a problem with accounts receivable. Then who cares what the turnover is? But it depends upon the company. Obviously, efficiency, we need to have some measure of efficiency. We need to have all the measures of profitability. We need some measure of coverage. We need some measure of leverage. All right, so you get the idea. So you're going to have, what, a dozen or more graphs, dozen to 15, dozen to a dozen and a half graphs with these ratios. And DuPont analysis is the next thing on our list here. Let's see, where did I have that? There we go. So DuPont analysis is part of this first deliverable. DuPont analysis is this idea of taking the ROE, net profits over equity, and breaking it into sub-ratios. The idea here is to try to figure out what makes the company's ROE what it currently is. And how has that varied in the past? And what do I think is going to happen in the future? And I'm going to compare that against a benchmark of my comparables, my 4 or 5 or 6 comparables. So I can break ROE down to a measure of profitability, that's net profit over sales. I can add to that the efficiency measure, which is sales over total assets. In other words, how many dollars of sales does a dollar worth of assets generate? And then the last element here is a measure of leverage. A dollar of equity supports how many dollars worth of assets? When I multiply all three of those ratios together, I get ROE. But by breaking them out, I can tell, compared to, say, the comparables, is RPM International, are they better at generating a very wide profit margin? Or more efficient, higher dollars worth of sales per dollar worth of assets? Or just, maybe they just have more leverage. Maybe they use more debt than everybody else. And that might drive a higher ROE, or maybe it's some combination of the two things. Another thing to think about as you're analyzing this firm, you all are, you're like investigators. You're investigating what makes this firm tick. And these are not the end results. These are simply ways to guide you to look further. So let's say, for instance, that I find that RPM has a higher than their peers ROE. And I also find that it actually is driven entirely by a very high profit, high profit margin. Oh, well, that's great, but my question as an analyst is that sustainable? Anytime I see something with a really high profit margin, I'm thinking, competition is ready to come in and take that away from me. So how safe is that profit margin? Well, I find out that RPM International has this patent on just a fantastic coating that is just generating, half of their sales, and that patent still has 15 years life left on it. And it's unlikely that anybody else is going to eclipse that. So, okay, that profit margin is probably going to remain for quite a few years into the future, so I can depend upon that. And their ROE is going to be higher. Great, fantastic. Or, hey, it's generated by this patent, but the patent expires in a year. Ooh, my profit margin is probably going to get hammered in about a year. My ROE is going to decline, price is going to follow it, right? So you get the idea. This is not an end all by itself. It's just pointing to where you need to look next. So think of yourself as private eyes. You can break down ROE into more components if you like. It all depends upon what you're trying to get. Here we break it down into to see tax efficiency here. So this breaks it up into 5 components. So we still have basically the profit margin, the efficiency, and the leverage, but now we have some measure of interest and tax efficiency. This one being the interest element, this one being the tax efficiency element. And then the last thing here, which is also the last item on our list here, this calculated coefficient of variation. That item, you may not have ever calculated a coefficient of variation. It's relatively simple. It's the standard deviation of the series divided by the mean, SD over mu. What's that actually tell us, though? I'm going to get this coefficient of variation for both the sales, revenue, in other words, and for the operating profits. How many of you have heard of financial leverage? You need to see all the hands going up. Yes, right. How many of you have heard of operating leverage? I know that they talk about it in accounting. Sometimes I question whether they're talking about it in the same sense that I think of operating leverage. Anybody know what operating leverage is? No? No guesses? Yeah.
I believe it's fixed costs over total.
Right, exactly. Yeah, and how can that create this leverage effect. Because when we talk about financial leverage, what we're talking about is using debt. And the more debt we have, the more fixed interest costs we have over any short-term period of time. So if revenues drop off and all of a sudden become less than our interest costs, we're going to be in deep trouble if that continues, right? So we kind of keep leverage at some sort of manageable level so that no matter what happens in the next few years in terms of revenue, we'll still be able to cover our interest payments and keep the company alive. Well, this idea of operating leverage is the same thing, except it relates to fixed costs versus variable costs. If all of my cost structure is variable, then as revenues drop off, my cost structure drops off, and so my operating profits fall as well. But they kind of go like this. They move together. So I'd expect to get a coefficient of variation for each of those that is relatively close to one another. But if I have a high degree of fixed costs and only a small component of variable costs, in other words, I've got this huge factory, plant property and equipment over there that if I don't run widgets through there, I still pay millions of dollars to keep that thing moving, just to keep it up to, keep it from rusting and deteriorating. Plus the expense of paying for the thing to start with. So if revenues drop off by a little bit, my cost structure pretty much stays the same. What happens to operating profits? Down through the floor. So there I would see the coefficient of variation for operating profits as much higher than for my revenues. And I'd want to account for that. And again, this is not an end all in itself. This is just a hint of what's management dealing with? What are the risks out there? I'd also ideally, now I don't know if RPM International has much exposure in foreign currencies. I want to know their exposure to foreign currencies. Sherwin-Williams certainly does. RPM's small enough, maybe they don't. But you've got exposure both on the supplier side and on the selling side to your customers. So you want to know about, so you've got operating risk, you've got currency risk, and you've got financial risk. This just gives you some sense of whether you have a lot of operating risk. And that's it for the notes PDF. Time, good, okay. One last item here. So you're going to want to plot all these ratios that you got. Once you know your comparables, your 4, 5, or 6 comparables, and you've downloaded the ratios for them. By the way, not only some of the ratios you'll have to get another tab in Bloomberg, the PE, the P, price to cash flow, price to sales. Those are actually on a different tab. They're on multiples tab. So jot that down as you're navigating through Bloomberg. So you've got all these ratios in a spreadsheet for your 5 companies, your 4 comps and RPM. Now you're going to want to plot those. You want to do an average of the comps and plot that average against RPM over the past 5 years. Now, again, we can't just do this mindlessly. We have to look at all 4 companies. Are there any ratios that are really out of bounds that look crazy high or low? I'm going to want to dig in and figure out why they're crazy high or low. Now, I may want to ultimately throw them out, but I can't just go, well, this is too high, throw it out. No, that's wrong. I need to know why it's too high. Maybe there's a data error. Could be. It happens. So anyway, once I've done that and I've cleaned my data, I've got the average. Now I plot it. And now I can see how RPM is doing relative to my comparables over time. Is their ROE getting better relative to the comps or worse? Or is it staying about the same? Likewise on efficiency, on liquidity, on coverage, and so on. So again, this is not an end in itself. This is more hints as to where to look in greater detail about the company and make sure that you understand what's going on inside the company. So that's deliverable 1. The other thing I wanted to show you, here's a full version of that Darden Restaurant, DRI, analyst report. Here's that executive summary. It just basically gives you all the key things that you need to know about Darden right here on a single page. So here's our recommendation, hold. Here's the current price. Here's the price target. This is where we think price is going to be in 12 months. And that's kind of where we want to shoot with the RPM thing too. What kind of fund is, or what kind of company is it? Large cap growth. And then some other important statistic details, usually a price chart like this with volume, with stock splits, dividend, earnings announcements, whatever you think is relevant, plus a little bit of a detail about what's going on inside the company. So you're trying to give a snapshot to your clientele. And then they go on, of course, and here's all the detail. Now, here again, I don't expect your reports to look like this. In fact, I ask you some very specific things. But I would look at this so that you get some idea of this is kind of the gold standard. This is what we're shooting for. So there's that. Here's the mid-year outlook for specialty chemicals. I believe RPM is specialty chemicals. I'll have to double check that. But I will upload this for you from Bloomberg. This may or may not be the most current one, so we might be able to actually reuse this. This was, I uploaded this when we did Sherwin-Williams this past summer. So this gives you an outlook for that industry. That's that industry forecast. And then I've got some other details. Demodern has some great stuff. This particular one is on valuing firms with negative earnings. That was more applicable to a different security analysis we did where we had a company that did have short-term negative earnings. So this is kind of a synopsis that Demodern has put together about what do I do with a company with negative earnings? Well, you already should have a sense of what you do, right? Well, one thing I could do is use the RIM model because it might be positive cash flows. I could still value it on that basis. But obviously, the other way is to simply use a discounted cash flow at DCF. So those are resources that you'll have available to you. All right, so before I go further, got about 20 minutes. Questions on this, because this is the first deliverable. This is what you're going to have to start working on. I hope to have this uploaded and available to you by tomorrow morning. So you can start as soon as tomorrow morning.
Do we have access to the terminal, like on our computers? Like, is that still down? Like, I don't necessarily know how to operate that. So
Yeah, it's not down per se. Now, I actually finally got an appointment with Joy Lowenworth at Bloomberg for 3:30 tomorrow. I hope that she can simplify and give us some clearer instructions. But the simple answer to getting into the terminal, one of two ways. Easiest, go downstairs, physical terminal, boom, you're in. You can download there. Make sure that when you're downloading your spreadsheets that you're not downloading a spreadsheet with formulas, but you're copying and pasting the values. That's a problem that you can encounter. Bloomberg uses this thing called the DDE, Dynamic Data Exchange System. It's an old system that Microsoft has had in Excel for decades. But basically what that does is that allows Excel to link up with another database. That database can feed live updates to whatever data is in your Excel spreadsheet. That's really handy if you're looking at prices changing and things like that. It's not so handy if you're just trying to download 5 years worth of financial data and ratios, right? I don't care, it's not going to change, but it still downloads as a formula. So you'll need to copy and paste to values. There are some other tricks you can do some reading on Bloomberg about that, but to get into the terminal, just simply go downstairs. The remote access, bba.bloomberg.net. If you already have a login, just go to that website. log in there. It'll ask you to enter a code. And then I typically use the drop-down menu and open the terminal within the browser. At least that works really well on my Mac. What you'll see is a white screen with a little circle quadrants in gray circling. You know you're on your way in. If you don't see that, or you see a black screen with like blue dots circling, you know you're not getting it. Somebody's on the terminal either downstairs or another remote login. You're going to have to wait. So, but remote access is not impossible. Read the instructions on the bba.bloomberg.net page. If you haven't already if you haven't done that, you have to download the Citrix receiver and have that installed and then restart your browser. You can't use IE, but you can use, sorry about that. You can use Chrome or Safari. I've had very good luck with Safari working on Mac. So yes, I don't know that, hopefully that wasn't too convoluted an answer to your question.
Yeah, I'll figure it out.
I'd be happy to help too.
Yeah, I think just navigating it's gonna be difficult, because we
It's-
haven't really seen that yet, so I don't know how to.
The best way is to get in there and start playing with it. I don't know, I'm considerably older and presumably in a generation of Luddites, shall we say. But basically, you can't break it. So just work with it and see what you come up with. Read instructions. If those don't work, reboot the computer. You know the drill. And unfortunately, Bloomberg is a lot this way. You look at the interface that I just showed you. That's decades old. They refuse to change, partly because their customer base doesn't want to change. They know how to run it, and it's up to us to figure it out. So think of this as a history lesson. You're getting to see what it was like when I was in school and was using mainly text-based interfaces. Their interface is definitely not a GUI interface. I mean, it is antiquated, but their data is good. They got no competition. Yeah, there's Thomson Reuters, but everybody has a Bloomberg terminal. Some people have a Thomson and Reuters terminal too. So sorry, I can't give you a better answer, but you're going to need it in the real world. You may as well learn it now. And there's a steep learning curve on it. And I'm around to help. I just walked somebody through section 51. We sat down in about 30, 45 minutes, walked through the whole thing. And I'm happy to do that as well. Other questions? About the deliverable. All right, let's jump into this. This is the second deliverable. We have about 15 minutes. The pro forma financial statement is one of the things that's probably going to eat up the most time for one of your teammates, or maybe two of you work together on this. I'd strongly recommend that you have whoever is best with Excel working on this. What you're trying to do is to create a set of financial statements that go out into the future that best reflect what you think RPM International is going to look like in 5 years from a financial statement perspective. And that means also that when I go in and look at your Excel spreadsheet, that I'm going to be able to go in and you've got a growth assumption up here in cell A1 or wherever you have it. And I change that growth assumption and it's going to update all the revenue throughout year 1 through year 5 in the future. Not only that, it's going to update the balance sheet, and the balance sheet is going to still balance. That's no small trick, because remember, when you close out the income statement, what happens to the retained earnings? What happens to what you don't pay out as dividend? It goes onto the balance sheet at the beginning of the balance sheet for the next year, right? So you're going to have to transfer that to your balance sheet. And then, oh, wait a minute. I've got changes in assets, I've got investments, I've got net working capital is changing, PPE is changing. So that means my balance sheet may not balance. How am I going to balance it? Well, you've got to make some assumptions. Am I going to keep leverage the same? Do I think RPM is going to keep their leverage the same is the more important question. If I think they're going to keep their leverage about the same, then that's what I intend to do in my pro forma. If management has said in their most recent 10K, hey, I think we need to lever up a bit, we're a little under levered, then I'm probably going to reflect that in my pro forma. Maybe they say we're a bit over levered, we're a bit concerned that we have too much debt, we're paying off debt, we're doing a seasoned equity offering next year to help pay off some of that debt. Okay, then I'm going to want my financials to reflect that. So you need to take whatever assumptions you build into your spreadsheet and make sure that they map back to what management intends to do and match your assumptions. I've got a little video workshop that I did. I think it was this past summer. Right here, that's probably a good starting point. I walked through just kind of the basics of what is a percent of sales pro forma. And then I actually take the real live data that we had. I think this was Sherwin-Williams. It could have been Chipotle. I forget when I did that video. But nevertheless, I actually show you how I create the formulas and connect the income statement to the balance sheet and then force the balance using formulas, right? So when I go up and I change that growth rate assumption, everything updates, balance sheets balance all out to 5 years from now. So take a look at that video. That will help you a lot. And again, I'm always a resource, right? So you get to a certain point, let's set up a Zoom meeting and I'll walk you through where do you go from here. But at least look at the video and get to a certain point where you hit a roadblock and then let's talk. All right. So that's the pro forma. Why do I need that pro forma? I need that pro forma to do the discounted cash flow analysis. That's kind of my gold standard valuation technique. Chapter 6, we looked at RIM, DDM, cash flow, free cash flow, relative valuation. What they didn't look at was the more complicated, more robust discounted cash flow analysis, which is driven by this pro forma. And that is right down here. So this step 5 right here, once you have your pro forma, you can use that pro forma to create a free cash flow to equity at the end of each year. Once you have that free cash flow to equity, then you get a terminal value from year 2025 going forward. And then you discount all of that back to today at your K, and you have a value. Now, the nice thing about that valuation technique is that embeds a lot of the assumptions that you've made that are missed by the DDM or the relative valuation models. So you get a much more credible, reliable, robust model by doing this pro forma and then doing the DCF with the data out of the pro forma. You're also going to use, though, a residual income model. And actually, you could, in this case, since RPM does pay a dividend, you could use the DDM instead. I'd recommend one or the other. Ideally, do both. See what sort of differences. So these are still back of the envelope. I really rely more on that DCF. We'll also do a relative valuation. And that's instead of doing what we did in the book, which was to look back for the company itself, we're going to look at the comparables right now. What are the comps PEs? Average those together. And maybe you put more weight on one comp than the other because you think that's a more accurate or better fit to the company, to RPM. You could do some sort of weighted scheme instead of just equally weighted average. And then you've got your forecasted earnings for the next year for the company. Cash flows. Forecasted cash flows. I was correct the first time, earnings, because we're doing PE. So you got your PE, you got your forecasted earnings, PE times forecasted earnings give you the value of the company, right? So that's the relative valuation. So you've got 3 different valuation techniques. And you might get 3 different answers out of that. You also need to do sensitivity analysis, because as we all know, if I give you a point estimate, I am almost always going to be wrong, either too high or too low. But if I give you a range, I've got a much better chance of the actual falling somewhere within that range. I'm not going to ask you to do a really robust sensitivity analysis. For that, we really need some sort of modeling software plugin. There are a couple of plugins. If you've got the time and you've got the interest, there's some really cool plugins for Excel. Crystal Ball and @Risk, the @ symbol, RASK. They both do this Monte Carlo simulation technique. And you can get, basically it plots out an entire range and a distribution for where the expected price is going to fall. All I'm asking you to do is base case, best case, worst case. That's a minimum. But if you want to do this other technique, feel free to download the software. I'd be happy to help you with it. @Risk is not too hard to use. You can get a trial version for free. And then 2 other things before, yeah, we got time to finish these 2 up. Before you can do any of the valuation models, you need some sort of growth rate, you need some sort of discount rate or required rate of return. In the homework, we were calculating growth rate. How? Well, we're using arithmetic or geometric averages. We're using sustainable growth rates. And that's pretty much where we stopped. When we were calculating a discount rate, we would be given a beta, we would be given a market risk premium and a risk-free rate. We would plug and chug and out pops a required rate of return. It's not that easy in the real world. In the real world, let me start with the last one first. Let's start with our K. What's my beta? Well, you can certainly go to Bloomberg and they'll give you a beta. You could go to Zacks, they'll give you a beta. You could go to Yahoo Finance, they'll give you a beta. None of those betas may agree with one another, by the way. And in most cases, except Bloomberg, you probably don't even know how they computed that beta. How many years did they go back? What sort of frequency did they use? Is this appropriate for this particular company? So what I want you to do in this project is you're going to compute your own data. That requires that you download price data, convert it to returns, and then regress the returns of the company on the returns of the market. Usually we'll use the S&P 500 index as a proxy for the market. You run that regression in Excel. And if you haven't used the regression function in Excel, it's in data analysis pack. And it'll spit out all the relevant statistics. I'm not going to ask you to invert matrices or any of that stuff. Just use the package. But you're going to get a beta. You're also going to get a t-stat on that beta and a p-value, and you're going to get an r-squared out of that regression. And you're going to use that to determine, hey, is this a beta I can rely on? And then again, you're going to use best worst case scenarios. If I've got really high t-stats, low p-values, and a high r-squared, okay, I might narrow that range. If I have low t-stat, high p-value, and low r-squared, I'm going to increase the range. Then I still have 2 other things I have to estimate, right? Risk-free rate and the market risk premium. And again, we're given that in homework problems, but in the real world, that's not a given. What if I were to use the T-bill rate, what would my risk-free rate typically be today? Very close to 0. But we know that this period of time has been historic lows for T-bill rates. Normally, 10 years ago, I would have said, use a T-bill rate, easy. Today, what do I use? Oftentimes people are using like a T-note, 10-year. Even a T-bond is not unreasonable to use because we're still talking, 2, 3%, 3.5%. So you've got to make some determination. Remember, we're projecting the value of this company out to many years into the future. More than likely, interest rates aren't going to stay at zero. So we need a higher risk-free rate. What about market risk premiums? There's been a great deal of debate over whether market risk premiums have gone down. Are they going to stay down? Again, it's up to you to think about it. I'm not saying you're going to have the right answer. I just want you to be thoughtful about it. Look back over 10 years. What was the market risk premium over the past 10 years? Well, wait a minute. 10 years only goes back to 2011. I don't even have a business cycle in that 10 years. I probably need to go back 15 or 20 years. So I need at least, I'd like to have one complete business cycle if I could. So you get the idea. These things become much more messy in the real world, but you're going to come up with some K. Likewise, growth rate. And perfect. 2 minutes. You know the historical method. So do I. So do computers. I don't need you for that. I can't pay you the amount of money that you make as an analyst for that. I need you to look into the future. I need you to figure out what it is that's going to impact the growth rate of RPM in the future. I want you to come up with at least 4 things that you think are going to impact it most importantly, have the greatest impact on it, and identify those. And then come up with some wild guess as to how much that's going to impact the old historical growth rate. So I think that there's this factor that will add 2 percentage points of growth, this factor -1, this factor +0.5, and this factor +3/4. Add that up, that's my growth rate going forward. So you got a paragraph on each of those factors about why it's a factor, why it's the most important factor, and about how much you think it's going to influence the growth rate going forward. That pretty much wraps up deliverable 2. We can continue this next Monday. Questions before we go? All right, thank you. Have a great rest of the week. I'll see you Monday.